Imagine this. It's April 2nd, 2025. You open your portfolio and it's a bloodbath. Trump just announced global tariffs, markets tank, headlines scream worst day since 2020. 8 days later, Trump hits pause. Markets rally, headlines flip, biggest surge since World War II. What changed? Not the companies, not the earnings, just the mood swing. In this video, I'll explain you why that shift is not a flaw, it's the feature, and how understanding this helped me to achieve 31% annual return over the last 6 years. So let's dive in! Back in the early 20th century, psychologist B.F. Skinner ran a simple experiment with pigeons. He put them in a box with a lever. Every time they tapped it, food came out. At first, it was simple. Tap the lever, get the food. Then he changed one thing. The food became random. Sometimes right away, sometimes after 10 tries, sometimes not at all. And the pigeons, they became nuts, tapping the lever for hours non-stop. Not for the food itself, but for the chance of a reward. The reason I'm telling you this story is because that's exactly what volatility feels like as an investor. You know the market will eventually reward you. History shows that after 10, 20, 30 years, things tend to work out. But in the short term, you don't know when the food is coming. You might get 20% return next year or flat returns for the next 5. And just like the pigeons, we sit there watching charts, refreshing our portfolios, trying to guess when the reward will show up. It makes people panic, trade on emotion, or quit altogether, even though deep down, they know the long-term odds are in their favor. As an investor, we want the market to work like a vending machine. You put money in, you get a return out, simple, predictable. And that's not how it works, and deep down, we know that. When the market swings wildly, it feels wrong, like the system is broken. That discomfort, it's not a flaw, it's the fee, not a fine. And there is a difference. A fine means you did something wrong, it's a punishment. A fee is what you pay to access something worthwhile. Market volatility is not a fine, you are not being punished. It's a fee, the cost of admission to the game of long-term wealth. Want certainty? Go buy a bond. But if you want real upside, 10, 15, maybe even 20% a year over time, there is a price. And that price is uncertainty. Not knowing when the reward will come, just trusting that it eventually will. The market doesn't hand out fixed rewards. It rewards those who stay and who lean in when prices fall hard. This is not just theory for me. I've lived it. Back in mid-February, my portfolio took a hit. I had been compounding at 28% annually over 6 years, while the S&P 500 was doing 15% over the same period. But by early April, that number had dropped a lot. I was down to 13%, the S&P was at 11%. Most people would have panicked, sold something, played defense. But I didn't sell a single stock. In fact, I did the opposite. I leaned in, hard. I doubled down on 2 companies I had mentioned in a video a month ago called Trump's Tariffs. While this market crash is not a bug, it's a feature that you can find in the description. Those 2 companies, Five Below and Uber. Since then, Five Below is up 91%, Uber is up 42% at the time of recording this video. My portfolio, back up, now compounding at 31% annually over the last 6 years, while the S&P sits at 13%. And just to be clear, I'm not saying this to flex, I'm just saying this to make a point. At this rate, I'm doubling my money every 2.5 years on average. The difference wasn't a new strategy, and it wasn't perfect timing. It was staying calm and acting when it felt hardest. In the end, the market rewards the investor that embraces volatility. The one who doesn't tap the lever in panic. The one who stays, endures the noise, and acts when others freeze. It's not about being a genius. It's about staying in the game. If that sounds like the kind of investor you want to be, hit likes, subscribe, and share your story in the comments.